Joining us right now for more on how the jobs number could impact the Fed's rate calculus as the central bank approaches its final policy meeting of the year, Roger Ferguson. He is the former Fed vice chairman, also a CNBC contributor. And Roger, these numbers were pretty much in line with what economists had been anticipating. But I don't know if you heard Joe Lavorgna and Jason Furman just arguing, not arguing back and forth, actually agreeing on things, agreeing that maybe the Fed doesn't need to cut rates anymore. What do you think of that?
Look, so I think there's an argument that, in fact, some of these numbers are a little more worrisome. The average hourly earning number is up a little bit, more than one might have expected. When that productivity is justifying that as an open question. So I think at the end of the day, this is going to be a close call, but they're likely to go with 25 basis points and then definitely be in pause and wait and see mode. They have put a lot of emphasis on inflation gradually returning to their 2% target. I think right now, the emphasis has got to be on gradual, and that I think suggests one more cut, more likely than not, and then pause, wait and see.
I guess the question would be, if we think we need to pause and look around, why not start immediately? Why do this last rate cut? You think it's necessary? Or you think it's something that the market's anticipating, so we should go ahead with it?
I think a couple of things. One, yes, market is anticipating we should go ahead with it. Now, this Fed is also capable of pushing back at the last minute, so we'll have to watch and see what happens. Secondly, I think they believe that they're still in restrictive territory more so than they need to be. And so on balance, I think we're going to get that cut. To be fair, we might get a dissent in that space. There might be a little regret that they went 50 for the first time. But I think this is going to be a no harm done if they take the cut. And a surprise to the market if they don't. And I think that, on balance, is going to lean towards the cut with a clear message that, they're not on a campaign at this stage. We'll wait and see afterwards.
You think inflation overall is heading back to 2.5%, 3%, back up?
Look, I have, for a long period of time, observed that core inflation has been sticky. There's a great deal of noise about headline inflation. The reason core inflation has been sticky has varied over time, but right now it has to do, with the housing sector. And that's something that's very difficult for them to control. So my concern has long been that, the return to 2 will be very delayed, and we may get ourselves stuck at some number, maybe something in the 2.5 range. And then it's a real dilemma for the Fed. How far do they go to try to get that last inch, so to speak, of inflation down? So I have long been worried that it's not going to be as smooth as we hope. And though there are reasons to push against this thought of the last mile being difficult, I'm still in the camp that it's not done until it's done.
Look, Jay Powell and company are in a pretty difficult position. Just this idea that they don't want inflation picking back up and getting sticky. Also don't want to be in a position where small businesses in particular can't get access to credit the way big businesses can, that they are still faced with these kind of crunching forces on both sides, the ability to access credit and the ability to deal with inflation when it's coming at them and things like higher wages and other things that they have to pay for. How do you resolve that? How do you deal with that? How do the scales on either side get weighed by the Fed?
Look, I think the scales get very much weighed towards the dual mandate with primacy on getting inflation back down. Everyone recognizes that getting inflation back to 2% will have uneven impacts across the economy, depending on access to credit, how interest sensitive one may be, the balance sheets of households and businesses, et cetera. But I think it's going to be very difficult for them to say, well, we will tolerate inflation, somewhat above the 2% number that we've been touting for a long period of time in order to deal with specific sectoral problems. I think in general, they think about this as a macro issue. They go back to the dual mandate. And, they have expressed a great deal of focus on the 2%. And I think it would be challenging for them to pull back at this stage because of, particular sectoral concerns.
But Roger, that's an argument for not doing anything right now. If you're focused on the dual mandate, but your primary concern is inflation, that's an argument to not cut again at this next meeting.
Right, but you're missing, yes, possibly 3 points, however. One is their analysis suggests, and most do agree, that over time inflation will get back closer to 2%. When that will hit is another question. Two, they clearly believe that they're continuing to be in restrictive territory, somewhat. They aren't certain of how much, but that's important. And third, I think, like it or not, the expectations built in the market, it will have to be removed pretty quickly, and I'm not sure they have room to do that. So I hear you. I'm not arguing that there's no logic to what you're saying. I think on balance, we're going to see the cut for the reasons I've just outlined, and then it'll be easy and clear that they should pause and wait and see what happens next.